and welcome to Market Open Direct Connect, a webinar series for companies to tell their story, why it's compelling and why it's an opportunity to invest. I'm your host, Stuart Walters, and we're joined here today by David Prentice, the Managing Director of Brookside Energy, ASX code BRK. David will provide an update on the company's second quarter results and current activity, and will also participate in a Q&A post-presentation. It's time to introduce our guest. David, welcome to Direct Connect, and over to you.
Thanks, Stewie. It's nice to be on, and thank you everybody for jumping on the webinar this morning. I appreciate the support of our shareholders, and obviously any new shareholders that have joined us since we did the Q1 results presentation. So today I'm just going to run through a little bit of obviously the results for the second quarter, and then provide some insight into kind of what's happening for the back half of this year. So, and then as Stu says, we'll do Q&A at the end. So without further ado, I'll move on to the disclaimer. So obviously take some time to read that. It's available on our website. We've also got the reserves cautionary statement down the bottom there. Where in situations where we're talking about EURs or the reserves, please take note of that cautionary statement. And onto the highlights. So look, we had another very good quarter. Cash receipts, as you can see there, just under 9 million, and positive operating cash flow of 2.6 million. We had net inflows of 4.8, so that's the 2.6 plus capital that we gathered from our working interest partners who are participating in the FMDP. So that offset the 15 odd million that we spent in capex, which was related to predominantly the FMDP, and then leaving us with a very robust cash balance at the end of the quarter of around 22 million. Net production was in line with forecast, with all wells performing in accordance with our pre-drill expectations. So just a little bit under 1100 BOE a day, and importantly 61% liquids. The 4 operated Swish AOL reserve definition wells continued to produce exceptional results. So we're 157,000 BOE for gross for the quarter, and cumulative production almost to the end of the quarter, almost 2 million barrels of oil equivalent. So those wells have really been a marvelous success story for us, and has really underpinned our ability to be able to roll into this very, very large company changing FMDP project that we have underway at the moment. Drilling operations at the FMDP went particularly well. We're ahead of schedule, under budget, and 0 HSE incidents. So look, we're absolutely delighted with the way that went. We were able to get all of the laterals drilled as planned out to their full lateral length, landing the casing in the lateral part of the wellbore, and then casing it in the right part of the formation. So that's obviously a fantastic result, significantly de-risking the FMDP project. Also during the quarter, we moved quickly with the construction of the Sanford Pad production facility. So these are much larger tank batteries and separation facilities than we would typically build for a single well pad. So this is a pretty large undertaking. We had much of that construction work done in factories in Oakland. Probably the best well in the play so far, being the Gapsdale continental operated Gapsdale well. So that's again going to add about 150 barrels of oil equivalent to our production stream over the next couple of years, and that's in addition to the 2,500 BOE a day guidance that we have been talking about from the boosting production from the PDP reserves. We also touched on the Swish AOI FFD, so full field development that we ticked off in the second quarter. That work will start in the early part of 2025, and again that's the opening up the pathway for another big jump in production out to sort of 4,500 to 5,000 BOE out to FY 2028, and that's really, I guess, the marvelous growth story that we're going to be able to undertake off the back of the results of the FMDP. Just wanted to confirm everybody can hear me clearly, Stu. Everything's okay on that front? Oh, I'm having trouble hearing you for some reason.
Yeah, it cut out a little bit before, but okay.
Okay, perfect. All right, so on to the 12-month performance. We put these charts into the quarterly report on a regular basis, just to give people kind of a rolling picture of how everything's going. So net production, you can see there, just coming down in line with forecast. So no surprises there. We're sort of approaching the low point in our production profile, and you'll see that start to turn around in the back half of this year, as we bring the FMDP wells on. So in terms of what the company looks like moving forward, you're probably looking at, you know, the low point in our production. And similar story with revenue. Again, you know, all in line with our modelling and predictions, and obviously very pleasing results. In terms of operating income, it's a little bit choppy there over the last 3 quarters. That's really a function of timing. So when we receive the checks from the refineries or the gas processing people, in terms of, you know, which quarter we receive it in, we're obviously reporting that on a cash basis, not an accrual basis. So it jumps around a little bit, but nothing to report there really. And then on net cash, you know, started out with around 32 odd million in cash at the end of Q1. You can see there, you know, good contribution in revenue, and a little bit of interest, and then receipts from working interest partners, and then obviously CapEx. You know, CapEx is obviously the big thing there. As I say, most of that sheeted home to the very exciting FMDP project. So netting out with that 22 odd million closing cash at the end of the second quarter. So you know, all in line with our forecasts and pleasing results. A little bit on the performance of those reserve definition wells. I'm just sort of, you know, really making the point here that you know, this is really the engine room of the company. Enabled us to be able to roll into this FMDP and fund it out of cash flow. So this is super important, the performance of these wells. And you can see some pretty remarkable numbers there in terms of you know, time to pay out, and probably pleasingly, you know, you can look at the Jewel well, for example, which is coming up for its 3rd anniversary at the end of this month. Already 650 odd thousand barrels of oil equivalent produced. So, you know, just a stunning well. And then, you know, the Wolfpack well, much younger, already at 500,000 barrels of oil equivalent. And when you think of, put that in the context of our predicted EURs for these wells, or ultimate recoveries for these wells, they're performing very, very well. And you know, we're getting a lot of that liquids production early, which is driving the strong cash position and giving us the ability to recycle that capital into the FMDP. So everything on track there, looking fantastic. So in terms of the numbers for the quarter, gross operated volumes, just under 164,000 barrels of oil equivalent, 62% liquids, giving us just under 100,000 net to the group. So again, that's still that strong liquids component, even though the wells are now, you know, those FMDP wells are now getting a little bit, you know, a little bit older, and so they're getting gassier. So it's really pleasing to see that liquids rate remaining, that liquids percentage remaining so high. I touched on the cash receipts. So cash receipts of 8.7 on sales volume of 180 odd thousand barrels of oil equivalent. You can see a difference there between what we get paid for and what we produce. So the production number is what we produce at the wellhead. Sales volumes is what we sell during the period. So there's always going to be a difference there, and giving us that realised price of $32 US per barrel of oil equivalent. Cash expenses, as you know, pretty much in line with previous quarter. Very low OPEX again, you know, reflecting all of those sort of positive things that we talk about for these Swish AOI wells. So, you know, no impurities, very good quality crude, high liquids content, very low produced water. So all of that comes down to these low operating costs, and gives us the ability to harvest, you know, this fantastic margin on these wells. So staff and admin and corporate costs were in line, 1.5 million. and then CapEx net of 12.8 million. Pretty much, not 99% of that sheeted home to the FMDP and or the Gapstow operation. So again, in line with budget, although probably slightly ahead of budget or under budget, given the performance of the drilling at the FMDP, which is a good segue into the FMDP itself. So just some stats here. We drilled all of those wells, got to TD, to plan TD. We landed the laterals in the exact part of the formation that we wanted to. We drilled 60-odd thousand feet of lateral. To put that into context, about 19 kilometres of wellbore drilled, and 0 HSE incidents. Drilled in 115 days versus a projected drilling time of 136 days, so 3 weeks ahead of schedule. That's going to have a very positive impact in terms of cash flow and budgeting. As I say, they all reached pre-drill lateral length and have been successfully cased. So this is a really big moment in the history of the company in terms of de-risking this project. It's a large undertaking for a company our size, and for us to be able to get all those wells drilled down, cased and cemented, ahead of budget, without any issues is a testament to the quality of our team and the planning that goes into executing these projects. And we're a long way down the track now with completion operations underway on the Rocket well, to getting all of that risk put behind us and starting to see some barrels and some gas coming to the surface facilities and to sales. So look, I can't stress enough here that the significance of us being able to drill these 4 wells, ahead of schedule, safely, and get full lateral length is going to have a very positive impact on our forecast for the production outcomes from these 4 wells. Little bit on the Gapstow. So at the same time as we were undertaking the FMDP, Continental were in there drilling that 9-well project that you can see there immediately to the south of the Bruins and Jewel DSUs. So we participated in 7 of those 9 wells, with a working interest of around about 3% average per well, NRI of 2.24 NRI per well. As I said before, this is going to add about 150 barrels of oil equivalent to our 2,500 BOE guidance that we talked about, again, those operations have gone according to plan and are on schedule. So the last of those wells is currently being drilled. They're already out there getting ready for completion operations. I visited site last week, and you've got Continental operating that big project immediately to the south of us down there, getting ready to finish drilling the last well. I think they had 3 rigs running at the peak in that area, then getting ready for completion operations. And then immediately to the north of our Flames DSU, you had Ovintiv completing 2 wells in their project area. So it's super busy out there, and lots happening, and very positive. So then on to the Swish AOI full field development. So this is really, we signed off on this in the second quarter. This is really the next significant rolling out of the FMDP, and using the cash flows. The significant cash flows are going to be generated by that to be able to move into full field development of the balance of our DSUs. So there'll be another 16 odd horizontal wells to be drilled across the Bruins, Jewel and Rangers DSU. 126 odd million of capex over 3 years, which will be funded from our working capital and a modest credit facility, which we're working on at the moment. And that's going to be, see a very significant increase in production over the next 3 years. It'll see us sort of peak at north of 6,500 BOE per day in terms of peak production, but in terms of annual averages, we'll be somewhere around 4,500 to 5,000 BOE per day. And if you run all that at $70 WTI and 250 gas, we're going to be delivering revenues in excess of 100 million net income in excess of 50 million by FY 2028, and forecasting cumulative revenue over that period between now and the middle of 2028 of sort of 360 odd million US dollars, and net income of 156 odd million for just those Swish AOI reserves. So this is really the I guess looking at where the company's headed and the significance of this development. When you think, go out to that September of 2028 and look at what the company looks like, we'll have around US 50 million in cash at bank at the end of that period, having funded that 126 million of capex during that 3-year period. And then we'll have visibility on another 200 million US of net income between the middle of 2028 and out to the end of 2032. And so, at that point, we're in a position to really start to look at saying, okay, well, even if we took a big chunk of that 45 to 50 odd million of cash that we'd be sitting on in 2028 and returned, some of that to shareholders, and looked for, what's the growth beyond the Swish AOI, and probably, most significantly from an oil and gas E&P business point of view, at that point in January, we will have a very high, low decline production base that throws off sort of 1.5 to 1.6 million US a month in net income, which is able to fund those sort of growth initiatives, and we'll have a huge cash balance to be able to get out there and grow the business further from where we've got to. And if you go back and look at where we were when we first started taking acreage in the Swish AOI back in 2018, what kind of capital position we were in at that point, what we've been able to achieve with that very low starting point to what we'll be able to achieve when we've finished this full field development. We're as a business, we're super excited about the opportunities that are going to come from that. And just touching on some corporate stuff, so we had the annual general meeting during the quarter. Obviously, all resolutions were passed at the meeting. On the composition of the shareholder base, it's really pleasing to see that continuing consolidation of the top 20 now holding sort of 35% of the shares on issue. We continue to see strong inbound interest from US investors, and that's something that we're certainly obviously pleased to see, but also see that as a massive opportunity. Seeing US investors, particularly family office and high net worth type individuals that are looking at the oil and gas sector, trading on historically low multiples and seeing a marvelous opportunity. Clearly, our business, along with many of our peers, is mispriced here in the Australian market, and there's a real opportunity there for US investors, who understand the Anadarko Basin, understand the business, and see us as a deep value investment proposition. So we'll be doing more work, in the back half of this year, looking at opportunities to continue to attract US investors to the register. Board meetings, obviously, continue to have board meetings during the period, so we meet monthly, and that continued during the quarter. Investor relations, a couple of things during the quarter. We did the London 1-to-1 conference, which again was a good opportunity to get in front of European family office type investors who showed very strong interest in our business. And again, that kind of deep value trading on historically low multiples, no requirement to come back to shareholders for any additional capital. So all of that's driving high levels of interest in the stock. We also participated in the Gold Coast Investment Conference. I found that to be a particularly good conference. Again, lots of high net worth and individual investors based in Queensland attended that. So a very good response to that presentation and series of meetings. And we continue to get good interest coming in through our investor hub. Some stats there on how that went during the quarter. We're continuing to put more effort into that, looking at ways to improve that and get more responsive. Really, I guess, with the aim of trying to create a real community there around that investor hub and providing a really good source of information, not just on the company but on the macro picture as well, and be able to respond to shareholders' questions as they come in. So Stewie, that's kind of rattling through the quarter. Happy to take questions.
Dave, thank you. Great presentation. We've had a number of great questions come in, and these first two are quite similar. Does it remain correct that Brookside's cash balance will reduce due to expenditure on its well program to a low in Q4 calendar year 24, but given upcoming CapEx offset by ongoing production revenue, will there be no need for or expectation for a capital raise? And also, do you expect all remaining outflows to be covered by existing cash balance and ongoing production revenue?
Yeah, so as you say, those similar questions. So yes, that's correct. So the forecast cash flows show that we can deliver the FMDP out of our existing cash resources and from cash flow. So we're comfortable with how that looks. So yes, we'll see a low in the third, towards the end of the third quarter. We'll see a low in terms of our cash balance, but that will bounce back very rapidly in the fourth quarter as we bring these FMDP wells online. So in terms of visibility from a quarterly reporting point of view, it'll be pretty steady through the back half of this year and then start to grow dramatically in the fourth quarter and then into the first quarter of 2025. So no requirement to come to the market, all fully funded. And again, the importance of being able to get these wells drilled, ahead of schedule and under budget, and have the completion operations moving ahead smoothly is all kind of de-risking, those forward projections.
Can you outline what you see as upcoming price catalysts for the remainder of calendar year 24 and during calendar year 25?
It's going to be a super exciting back half of the year. Obviously, we're going to be flowing these wells back here. Completion operations underway now. Looking sort of at early September for that work to be finished. Start to flow the wells back in September. We'll see production and sales immediately as we start to flow the wells back. But really, peak production probably doesn't arrive until towards the end of October. So lots of good news there in terms of catalysts around the production coming from the FMDP wells. We'd love to see shareholders maybe starting a little book, predicting what's going to be the peak rate for the combined FMDP production from all the wells. That would be something we could get going on the investor hub. Who's going to make a prediction around where that's going to come, but it's very exciting. And then in terms of further catalysts beyond that, we're working on a bunch of initiatives, both sort of organic growth opportunities within the Swish AI itself, and other external sort of opportunities that we're swabbing down. So there's potential for something to come out of those initiatives. We'll see the production results from the Gap Stow also in the second half of this year. So again, important additional cash production and cash flow coming from that initiative, but also further confirmation of the quality of the rock out here and the work that Continental's doing. So plenty of catalysts between now and the end of the year, and then rolling straight into continuous operations in 2025 with the kickoff of the first FFD operations in early 2025.
Are you considering obtaining a debt facility of any size for additional flexibility, or are you comfortable that there will be no need for this?
No, look, we probably will put in place some kind of reserve-based revolving credit facility just to be prudent. It's a business of this size with this much cash flow and this capex ambitious capex program that we've got outlined for the next 3 years. It would be prudent for us to put in place some sort of revolving credit facility, but it will be modest and it will be reserve-based lending with a local US-based bank.
And when will the FMPD final working interest determination be expected? Current WI of 67% for Woodford v guided, 80% for Rocket. WI is approximately 40% versus 46% guided.
Yeah, so look, that's a moving feast. So that will continue to evolve over the next weeks and months as we get through the last bits and pieces of the regulatory filings for those FMDP wells, and we'd expect that that our guidance there is probably going to end up being conservative. We might end up with slightly higher working interest in those wells. But that will all be finalised once the final revenue decks are completed over the coming months.
You got any comments on the drop in average price received per BOE? March 2024 per quarter was approximately $40 per BOE versus June 30, 32 per BOE. Liquid contents were similar. Are there any specific product, oil, gas, natural gas, liquids driving the drop?
Yeah, so obviously natural gas prices have come off significantly in the last little while. So that's the biggest driver of that sort of increase in net BOE number. Those numbers do move around a little bit depending on how much we produce and then how much we sell during the quarter. But fundamentally, it's been driven by pricing.
Can I just add to that? Look, our costs are pretty steady. This is essentially a ratio you're looking at. So if production goes down a little bit, and obviously the ratio goes up, and it looks like it's a higher cost per BOE, but overall the costs don't move around that much. So just keep that in mind.
How long will flames be shut for during the FMDP completion?
Yeah, so the flames will be shut in for an extended period of time. Obviously, the well was shut in just before the completion of the Rocket well started, sort of a week ago, and it will be shut in for the entire period of completion operations across all 4 of those wells. So it'll be at least 4 weeks, and that's just good reservoir management, prudent, just to protect the reservoir and make sure that we get good stimulation across the other 4 wells.
Is the Bruins development likely to start in Q1 or Q2 of 25?
Look, it'll start in Q1. What does start mean? But yeah, like certainly in terms of our internal planning, we're intending to roll straight into that in the first quarter of 2025.
And the quantum of the credit facility needed for the full field development, and also does the financial year 28 net income guidance include this assumed credit facility?
Okay, so the credit facility I think we've talked about is sort of up to $15 million US is what we've talked about in previous presentations, and the net cash position of that sort of 50 odd million is net. So that's what we'll have available to us at the end of that period.
For Bruins production, as guided per Sawtooth graph, is that based on current WI 50%, which should increase substantially by post pooling? As a result, could there be another 1,000 BOE per day max flows potentially added to the production?
Well, I wouldn't like to be drawn on the numbers, but yeah, no, the questions, it's a good comment to make. Yeah, certainly they are. Those numbers are based on our predicted. Are based on our actual working interest, not our predicted working interest. So there is a significant upside in those numbers as we move through. For example, on the Bruins, we've got a very modest working interest in that unit now, and if you look at the track record of the company, since we first started drilling here, typically as we move into the drilling phase, we do pick up additional working interest through that process. So yes, there is some upside in those numbers.
And what are the risks associated with the FMDP, and how is Brookside mitigating them?
So the risks associated really are around executing on the operations. So in terms of the reservoir itself, that we understand the geology, we understand the reservoir. We've got very good visibility on what we expect these wells to perform like. You know, we're very happy with what we saw in the logs. So, you know, where's the risk? The risk was in the drilling. Could we get all the wells out to TD, you know, efficiently? Could we land the lateral in the right part of the formation? So that's all behind us. So that's fantastic. So, you know, now we've got to get all the very large volumes of water and sand that we pumped during the completion operation. We've got to get all of that put away efficiently, so on time and on budget, and make sure we get the best possible stimulation we can. We've got the best crew out there helping us with that, so you know we're almost a quarter of the way through that process now. So, and then lastly, drill out the plugs and flow the wells back. So in terms of, you know, of risk, you know, a lot of the operational risk is behind us now. You know, but we still got to get the sand put away, and once that's done, you know, drill out the plugs and let Mother Nature do what she does.
So we've got 3 more questions come in. How does Brookside's production compare to industry benchmarks, and what are the steps being taken to improve efficiency?
Okay, so in terms of industry benchmarks, you know, it depends kind of what benchmarks you're looking at, but in terms of you know, I think for us internally, it's all around operating costs and liquids content, right? So if you've got these very high liquids contents, particularly in the early parts of the production profile, you know, we typically, like for example, in the Wolfpack well and the Jewel well, you know, you saw you know, liquids contents higher than 80% in that initial flush production. That combined with the very low, you know, sub $10 per BOE operating costs, you know, just drives these high margins. So we compete very well with our US peers across all of these plays because of those very low OPEX. And then in terms of you know, as a business, you know, the other benchmark that we kind of really focus in on is obviously efficiency. And so being able to get these wells drilled, you know, ahead of schedule, on budget, or under budget is obviously a key driver of our success. And, you know, we're now, you know, we had 4 wells in production from that initial reserve definition drilling, and all of those, you know, were a marvelous success. And we're about to double the well count with the FNDP. And again, you know, the drilling has gone particularly well. No drilling issues, and you know, no safety issues, and we're ahead of budget. So I think we compare very well to both our US peers and our Australian peers.
And what are the company's plans regarding future share buybacks or dividends?
So as I said in the presentation, you know, it's really going to, you know, it's a sort of a 2-pronged attack there. If we see sustained higher oil prices in the period between sort of now and 2028, that sees surplus free cash flow that, you know, over and above what we've got budgeted in terms of funding that capex program, then, you know, that may provide us an opportunity to reinstate you know, a modest buyback. But the other alternative, of course, is to say, okay, well, out in 2028, you know, we'll have this very large amount of cash that we will have accumulated from the full field development operations, and have an enormous amount of cash visibility on an enormous amount of net income coming over the next 3 or 4 years. And so at that point, you've got the ability to make some decisions about capital allocation, and that may include, you know, distributing a large chunk of cash back to shareholders without compromising our ability to grow the business. So, you know, that's the holy grail. We'd be in a position where we could deliver a big return of capital to shareholders and still have plenty of capital available to grow the business from that low decline production base that we will have established, and that very strong future cash flow that we're looking at.
And last one that's come in, what are the long-term growth prospects for Brookside, particularly in terms of new drilling opportunities or acquisitions?
So in terms of you know, new opportunities, you know, if you look at that the sawtooth graph, you know, the challenge here is for us to add some additional drilling inventory between now and 2028 that fills out the back half of that chart, and that process is already underway. So we're looking at organic opportunities within the Swish to add additional DSUs and or drilling locations. We're also, obviously, starting to look at opportunities outside of Swish for us to be able to grow that drilling inventory, and so that process is already underway, and we've got nothing firm to be able to report to shareholders at this point, but certainly it's a very strong focus for us because we understand we're going to have all of this cash and cash flow, and we're going to need to be able to continue to grow the business post that sort of 2028 period.
David, thank you. That's everything that's come in today. So that concludes today's webinar. Another fantastic presentation and some outstanding questions. For more information about Brookside Energy, head to the company website, brooksideenergy.com.au. You can follow the company's investor hub or the company's social platforms, which are kept up to date and look great. Thank you to everyone for attending today's webinar. Another fantastic presentation. If you would like to hear from a specific company, please send me an email, stuart@marketopen.com.au, and I'll reach out to that company for you. David, thanks for your time today. Keep up the great work and look forward to chatting again soon.
Thanks, everybody.